All right. Hello, everybody. Welcome to today's Market View commentary with Hurley Investments. This is Keith Bybee, your presenter today. If you can hear me, go ahead and write in the questions tab and tell me that you can hear me talking. All right, I got one okay. I'm going to assume that means everybody else is good to go. Perfect. All right, guys. Well, I'll get started then right away. Again, my name is Keith Bybee. You've heard from me before. I work with Kevin. I'm a registered investment advisor with Hurley Investments. Kevin's on the road today and asked me to take over tonight and talk a little bit about a few things for you. Just to start out, what I want to talk about today is pretty simple. Just want to go over the simple way to look at stocks. And are these, can everyone see if I move this over here? Well, hopefully you can. I'll just move it back. The ads are a little annoying. So sorry about that in the background there. But all right, so to start off, I was talking to someone discussing, some stocks to look to get into back in fall last year. The comment was made to me, I just want stocks that, what is a good way to explain it? He said, I want stocks that have a solid 10-year track record of going up. That's really small. Let's go up to uh-oh. My computer's thinking. Sorry, guys. We just want Times New Roman. Just make it simple. Forget about it. Let's just do this. There. All right. So the comment was made. I just want stocks that have a 10-year track record going up. The logic behind that was just simply if a company has a chart that looks like this, with Apple in this case, that looks pretty good if you look at a 10-year chart. Hey, that looks great. Got a great track record of going up. Logic behind it is simply, well, if it has a good chart that looks like the price continues to go up over the last 10 years, this must be a reliable and solid, profitable, safe stock. So Since I know you guys probably know better, or maybe you have a good reason to tell me why this is a good way to pick a stock, I'm willing to listen. I'm open. But I want you guys to tell me, why do you think this might not be the best way to pick a stock? And there's plenty of reasons, so don't feel like you have to find the right one. Just whatever comes up in your mind first. What do you guys think? So maybe you're thinking, well, I don't know, that kind of makes sense to me. Let's think about it. What also has happened in the market for the last 10 years? What has the market done? Now, I know you guys know this. What do you think? So I got one answer from Bill. Might buy in at a high and not anticipate crash. Yeah, I mean, to put it more, as simply as that, we've gone through a 10-year market bull run. That has helped a stock like Apple, stock, most of the stocks that have gone up. Of course, here and there's some that have fallen on the way, or some that were late to the game, of course. But it doesn't make sense in my mind for these last 10 years to look back and say, well, because this such and such stock has gone up the last 10 years, that must mean it's a safe and reliable stock, and we can then continue to believe that it will go up for the next 10 years, right? So you're absolutely right, Bill. And I think the way I would put that is, we know where the stock has been, but where is it going to go? So let me highlight something that's incredibly important. The price of the stock is not the same as the company whose earnings, it's not the same as the company's earnings every quarter. You can have a stock that has made an amazing run up, and the earnings, the company's profit, does not justify it. Why would that happen? Well, there's a number of reasons, but let me fill in some of what I'm talking about, just so I don't get too far away. So the price of a stock I'll say the price history is not the same as the company's earnings or profit history. So why would a stock run up over the last 10 years and not justify? One reason is we have stock buybacks. The company through the Federal Reserve after the financial crisis, they made it easy to borrow money. Interest rates go down. It's super cheap to borrow money. It floods the market with cash, and companies and CEOs they can choose to just buy back shares. Oh, thank you. Autocorrect. What a wonderful thing. So easy money after financial crisis. What does it mean when company buys back shares? Well, if you have 100 shares and you buy back 50 of them, all of a sudden you have 50 less shares. And think about that for a minute. What does that mean? Does it mean that the company has made money? No, it means there's less shares available for the market. And that means supply and demand kicks in. There's less supply, more demand, and the stock kicks off. It takes off, and it can do it for years. So in that case, sometimes the company's earnings still justify where it's going. Like in the case of Apple, in the case of Amazon, not so much. And I had this chart out to 10 years that decided to reload on me and disappeared. So let me get that back up real quick. So there's tons of that happen. That you think of Amazon, a lot of companies still do it, but we're talking like extreme cases that have just rocketed some of these stocks all the way up and unjustified. Facebook was and now is more justified as they've gotten loads of cash and they're become more conservative, at least in their aggressiveness in debt and whatnot. Netflix. So those are just a couple of them. Obviously, the things have changed a little bit, but those are huge. Why else? I'm just gonna say, what is a good way to say this? Hype and Uh, high investor sentiment. So again, that goes to Amazon and Netflix especially. Especially Amazon. Gosh, I hate that stock. I buy stuff from Amazon all the time. Love it as a consumer. Man, it makes me want to swear sometimes how ridiculous that has gone up. Anyways, so those are a couple reasons. So what do we really need to pay attention to? Well, of course, history is still important, but when we're talking about where the stock's going to continue to go, we got to look at the fundamentals. We got to look at, we use, let me finish this thought. Past history is still important, but we need, if I could spell, so past history is important, but instead of looking at just a 10-year chart, what about the fundamentals of a company? What kind of things are we looking at? I don't want to get into so much of this because it's a completely different discussion for another time, and maybe something worth going in point by point. But we care about earnings per share. We care about return on equity. We like to see dividend. Have a steady increase. I don't need to explain that. Book value. If none of this is making sense or you're not familiar with these terms, don't worry about it. I'm just putting it on here for important metrics that make more sense than simply looking at a chart and picking a stock based on the chart and hoping it continues that trend for the next 10 years. All right. Guys, what kind of questions do you have about this? Thoughts and ideas? Here's another thought. You missed the run up. The point is, you should have gotten in Apple or Amazon or whatever way back here. Or here, or here, or whatever. Point being, you've at this point, since it's coincided so much with a 10-year bull market, you've missed it. You've missed part of it. Not necessarily with Apple, because you could still justify fundamentally why Apple could go up. Of course, oops, get back to the pointer. We go to check out Netflix. I mean, some of it doesn't look very pretty, but goodness. Should have got a Netflix 5 years ago, 6 years ago. Amazon. Oh man, it looks so pretty. Let me also point out, here's a good stretch of time where that went sideways for what, 2013, I think for a couple of years. Another sideways from 09 to 10. Right now, we're going through another sideways from September till now. It's not like some of these stocks haven't had periods of drawdowns or where they go sideways, or it's easy to look at the past 10 years and just say, oh, well, that looks great. Why can't I have that? Because there's more to a stock than simply the price. What is the risk? Well, darn it. So what? So what is the risk? What if I want Amazon now? Well, I kind of already answered that. But the price you pay is not worth the company's profit. So when this starts to become important and people realize, oh, well, you've just had a bunch of buybacks and your stock has run up, but your profit has lagged or has been terrible or just hasn't had any good growth trend, then how can we justify continuing to buy this stock? How can we justify sticking with this when there could be so many other opportunities? Let's go back to 6 months. Sorry, let's go back to a year. I like picking on Amazon. You dumb stock. So Amazon just barely hasn't gotten back to its high. It got crushed pretty bad last October. So let me write that in. Price you pay is not worth the company's profit. In other words, going to realize the hype is just hype, and they will eventually run. So let's take a look at, let's compare that. A lot of this also, if you look at this chart, has to do with overall market influences, especially in November on this area, where there was more talk of the Fed raising rates, there was more China trade issues that everybody was nervous about. So let's see how a stock like Disney fared during the same time. So I guess what I'm trying to look at right now is, compared to Amazon and Disney, how did those two stocks weather the market influences? Let me write that in. Comparing Amazon to Disney last 6 months. How did both of them weather the negative market influence? So still on Amazon here, let me just point out, topped out here about 2000-ish, bottomed out here around 1300-ish, just to do some math with you. So 2000 minus 200, 1100. Oops, doing my math wrong. $55% is how much from the top to the bottom Amazon fell. And boy, those were some crazy swings in here too. My goodness. Of course, it probably looked pretty similar with Disney, as I'll show you here in just a second. All right, Disney, come on. Some similarities. You can see this drawdown right here. That was definitely the market influencing that. Yes, the stock went sideways. But look at this. On the top here, same time frame, October 118 down to 100. %, right? Oh, actually that wrong. 15%. All right, so again, so comparing those two, Disney fell 15%. Amazon, keep writing X, 5%. Point I'm trying to make, guys, is we want undervalued. They're more durable through market downturns, meaning they are less influenced by them. I'm going to say undervalued. Solid, undervalued companies with solid fundamentals. These companies are less influenced by market downturns. Doesn't mean that they're not. I mean, doesn't mean that it's always going to have to be that way with every great stock that, you know, goes through the market, a bear market or whatnot. It just means that they're likely to lose less. And the other point is, you've heard us talking about Disney lately. Started the year around in this range here, 108 to 115, and struggled to get over 115. And man, if you guys were with me during one of the trade findings, I had recommended doing a bull call on Disney on this price around, I think it was around 116 at the time. And look where Disney has gone. We kind of caught it before they got a lot of hype. And, you know, some people, some clients and, you know, anyone that's invested in Disney and believed in it, they've seen it kind of go sideways for like 3 years now. And that's kind of frustrating, right? But the point I want to make is allows us to get in a good company before they start to get a lot of market hype or a lot of favorable sentiment. And when we collar trade, and protect, it allows us to be patient through those frustrating 3 years. When Disney went sideways, I'm going to say, and allowed us to build shares. I'll say accumulate. Through that time. To the point that now, my goodness, 120 was really kind of the number that just couldn't seem to get up for the last several years. And to see it break out finally is just such a wonderful and worthwhile thing to, you know, see things, see some sell-offs on some silly things on ESPN, and investors over worried about a smaller segment of the overall umbrella of Disney's incredible profit making brands and assets and whatnot. It's really nice to see it finally come to fruition and see things go up. And ironically, as I was talking to this individual that kind of brought up this point back in, I want to say, October, Disney's been pretty awesome if we were patient through that time. Apple, which is a great company. But it's more expensive. We've had to go through this big, huge downturn and see it come back up. The discussion was, well, I just want to sell my Disney. I don't want Disney. I'd rather have Apple. And again, I love Apple. I think it's a great company, a good stock, and worthwhile. But it was a question of putting all your eggs, or too many of your eggs, into one basket. We want stocks that have kind of gotten beat up for a couple of years, where we can catch them before they go up, catch that next 10-year run up. Who knows that maybe Disney will be that? I don't know. Maybe it won't, but the process that we use works. And I guess what I'm saying is it's important to look at the company and not just look at a chart. There you go, guys. Any thoughts that you'd like to add or questions? Am I just rambling? It's an important point. You got to have a few different stocks in your portfolio. You got to be diversified, but you don't need 1,000 stocks. You don't need several hundred. You just need some undervalued 5 or 6 stocks that really any one of them taking off in 1 year is just incredible and makes your whole year. And the other ones, if they go down, hey, let's build some shares. Let's accumulate shares so that we're paid for being into it and we really see things take off once things come around and the market starts to realize and agree with us. That's value in investing. That's the Warren Buffett way. All right, guys. Just to move on, where will our markets end this week? What do you guys think? Where do you think we're going to go? Up, down? Just to take a look at the charts, we're getting pretty close to not close, we are up at all-time highs. Just to give you a quick glimpse on some of these. Here's the NASDAQ. They all look pretty similar, right? Bill says flat. Maybe. I can definitely see Bill just looking at a chart and just by looking at some of our pivot points. This is the Dow, where we're kind of hitting this top here, and the same goes. Just keep that right there. We got a pivot point right there. We're overbought on the S&P. Way more overbought on the NASDAQ, and also that pivot point up there. All of them are kind of doing that same thing. So, Bill, I can see where you're coming from, and technically it is pretty justified to say flat or even down, looking at the chart. But the reason why I'm saying bullish or up is we have more earnings to come through, and I'm going to say a no on a Fed rate hike. More big earnings reports coming out, although Google didn't do great apparently. A big no on the Fed rate hike. Those are the two reasons that I think are going to continue to push up our markets higher. Any questions on those? Sorry, I'll stop scrolling here so you can look for a second. Any questions on our markets? S&P may end May 19, 3%. We had Google, which apparently missed. We still have some big ones, McDonald's, Apple, tomorrow. We've got Under Armour Thursday. Qualcomm Wednesday. Earnings reports, or excuse me, econ reports, other than most of it's less important than what I feel the Fed, how I feel the Fed may influence things with a no rate hike. Internationally, we have China with the PMI. But again, I'm going to say still earnings and a Fed rate hike are going to be the two big ones this week. That's all I had for you guys. I didn't have some articles today. These are, I believe, from last time, unless Kevin threw these on. in which case you'll have them for when we post this. As far as I'm concerned, though, any other questions you guys have, any thoughts? We can go way back up to the top on anything I've talked about. I'll give you a minute. Tell me what you think. If not, guys, I really appreciate the company and having the opportunity to chat with you. Appreciate the comments. All right, guys, that's it for me. Don't see any comments coming in. Appreciate the time again, and we will talk to you next time. Thanks for joining me.